amount of 25 shares at a limit not to exceed 192 for tomorrow, and then a good till canceled stop thereafter. And here, let's go ahead and do the math real quick. 178.54. And then our ATR on 70.63, which would be in the vicinity of our uptrend line, interestingly enough. So, 170.23 would be below this low here. So, bring this back. Okay. Make sure I did that properly. There we are, 170.63. So yes, about 22 points. But if this thing keeps running for us, we could be just fine. But we're not targeting anything, even though we could see that, our last peak was up there at the highs, 214, about 215 a share. So if we got there, you'd still be looking at about a 1-to-1 risk versus reward. So the takeaway on this one, everybody, might be, yeah, we're going to place this trade. We're doing it for a much smaller share allotment than we might normally. But even if we give back and get out at the stop we set, you know what? We're going to still be losing only about $500 to $600 approximately, even though we can't guarantee that because, of course, no execution is no price is guaranteed on our stop orders. But here we are, buying 25 at a price under 192 for tomorrow. So we've got a stop at 170.63. No guarantee we get executed at that price, however. All right, let me go ahead and send that one off. We are in. So there you go, everybody. There's a quick look at our example portfolio and setting the table for tomorrow with one new purchase in tech and one new attempted purchase in material space. Hopefully that's helpful. I'm hopeful for the conversation. First and foremost, I absolutely love it when I get questions that say, or comments even that say, like Beth and Jay both saying, yeah, this doesn't work for me. This isn't what I would normally do. I get it and I completely understand it. And I love that we can have that discourse back and forth, and your questions and your comments lead me to forced to explain why we're doing it this way. And I absolutely am happy to do that. And I hope the takeaway is there's a lot of ways to go about this. We can massage our process to fit every single one of those instances we want to participate in. It really comes down to how we choose to manage that trade. So hopefully we've generated a few different ideas with that in mind. So big thanks to Connie today. Thanks, Connie. Make sure you're following us both on X, Connie Hill CS, Kevin Horner CS. If this conversation was helpful, that thumbs up down below helps me out a bunch on the replay of this class when we get it reviewed and into the archives. But make sure you're subscribed to the channel and you're following Connie and me. We always appreciate hearing from you, everybody. Have a great rest of your Tuesday evening. I look forward to seeing you tomorrow morning for Trader Talk at Market Open, 7:30 a.m. Mountain, 9:30 a.m. Eastern. Have a great evening, everybody.
You will cooperate.
Happy Tuesday to you as we discuss for this webcast the Investing Master Series. I want to also welcome with us in the chat Scott Thompson. So say hello, Scott. We got many of you here today. We got Will with us, Gary with us, Riceford, Trader Joe, Dom, and many others. Good morning. Some of you are over in Europe. Good afternoon to you. Now, just real quick as we get started, remember that I do post educational content on X. There's my handle. Also, a quick reminder that this webcast, we're going to talk about stocks and or options. Remember, when we talk about options, we'll show some examples of past and current examples. Remember that options carry a high level of risk and are not suitable for all investors. When we talk about the information, it's done for general informational purposes only. When we show our examples, we're going to use the pay-playing software application and understand that that is a gateway to paper trading. There's also web-based, but we're going to use the software. Also, quick reminder that the investing we talk about, or all investing, involves risk. Without risk, there's no reward. So we want to be made aware of what is the risk of the strategy and what could go wrong. And also remember when we talk about examples, if we bring up, let's say, cash secured puts, covered calls, those are short options, selling a call, selling a put, and understanding that those could be assigned at any time up to expiration, regardless of the in-the-money amount, okay? They're standing obligation. Also, when we talk about examples, we're going to talk about the current market. We're going to talk about past management examples, and we're going to talk about new examples. So that's kind of the theme that we tend to focus on Tuesdays. The purpose of it is where you really kind of get into learning the routine, okay, of maybe trading and or investing. Now, with that said, is one of the first things we like to look at is kind of, I call it the sentiment, okay? Now, obviously, if we were to look at, let's say, the sentiment, we look at the 4 ticker symbols. Oil itself, VIX, US dollar, and the rand. Now, that has, like, you didn't say ESP. These 4, oil, US dollar, interest rates, VIX, can influence what the market is doing. So, we woke up this morning, and about what time we woke up, we saw crude oil down about $2. Now, sometimes as stock market investors, we kind of like when oil goes down somewhat. Okay, now oil is down $2, not life-changing. Okay, down 2.8%. You might be thinking equities might be a little higher. Some equities, discretionary equities, like some airlines, travel, leisure, and so on. That's the idea. Crude oil slightly lower. Now, if we also look at the VIX, the one thing we've been watching about the VIX is the VIX has had the chance to go up. Okay, hasn't really moved up a whole lot. Some of that's just I think hasn't. Because you got to remember, the higher up the VIX goes, the greater the chance that you have of getting the position stopped down. Rising VIX, usually lower stock prices. All right, so far, that pullback has been somewhat minimal so far. Now, if we look at the US dollar, we're going to see that US dollar continuing to grind to the downside. We're not at the lows, but we're still holding this downward pattern. Why do we care? Well, when we talk about, let's say, the US dollar, we're actually talking about commodities, precious metals, that is. And the last one is those interest rates. The reason why we care about the interest rates is these companies, us as consumers, mortgages, car loans, credit cards, corporations, they borrow. And that borrowing rate tends to be based off what that 10-year rate is. That rate, see over the right-hand side, from 39, which is 3.9, up to 4.7. This has gone from the lower left to the upper right, so rates have risen, pushing some sectors down. If this goes up more steeply, areas of growth tend to underperform. We would also lose utilities. Okay, now, so when we look at the 4, rates did fall. We saw VIX kind of flattening out somewhat. We saw crude oil down. We're speculating that if more of these are down before, probably equities might be a little bit more bullish. We also got actually PM at or above the 192. That was actually, we did the alert yesterday. We just got that right now. Now, let's pull this up just real quick. Now, let's kind of talk about the equity markets. Now, I'm going to hold the Dow Jones first. Dow Jones is the one of the 4 in indices that's gotten a little bit of a bounce. Now, one of the things we're going to talk about here today is kind of crossovers. And a lot of times when you look at crossovers, like we know about them, but we don't necessarily trade them. And then we look back and say, oh yeah, that was where the entry was. But we didn't necessarily trade it. Okay? Today I want to kind of focus about trading what we're seeing. Now, if we take a look at the Dow, we've had almost a crossover. today's price action getting above not only the 10-period moving average, but the 20 as well. If we remember, think large caps. In our examples, I'm going to give you a hint. The DJX is where we're finding many of those examples. When we look at, let's say, the SPX, the top-heavy technology sector, that is still staying above that 7,600 level, not above the 20 yet. Remember, this is top-heavy technology. If we flatten all sectors out and say, look, don't top-heavy technology, the equal weight S&P 500 still bullish. I'm going to say it again, okay? Be very careful who you listen to the stock market. You want to be actually making your decisions based on charts, not necessarily what someone else said. When we look at the SPX EW, it has left a trail of higher highs and higher lows. And a lot of times, sometimes, or a lot of times, people read the market wrong and they pucker to emotion. Okay? The equal weight index, when we pull this up, if we're to flatten this out and try to bring up the Hawkinashi, you're still actually making higher lows on the Hawkinashi chart, which is smoothing it out. We pull this up to a weekly chart, and what we see, it's about as strong of a rope of 45-degree angles as you can get. And people are talking about the market bearish. Now, again, in this class, we're making decisions based on charts. That doesn't mean there's no risk. That just means we're taking risks to see if that trend might continue. Now, where we know and where there has been some struggle still is the technology. It's staying above the Fibonacci that we've had drawn, 28,850 or so. The semiconductors have really just been, I think they've been more tame to some degree. Okay, we had a little reversal, and then there was kind of some news that came out about semiconductors. We have NVIDIA coming out with earnings, what is it, tomorrow? And if you look at that, 826, yes, tomorrow after the bell. Semis have been a struggle, and that's what we've kind of been talking about, the equal weight, getting away from that area to some degree. The Russell small caps are actually now below the support level, so of the four, really the Dow Jones and the S&P 500 equal weight that are leading the way. Now, there was a question regarding yesterday in one of the chats I was in, where someone said, are you surprised that healthcare has actually gone up? No. Okay? When there is volatility in the growth area, it's not that people don't have money. Switching what they're buying, technology, the discretionaries might be a little softer, they still got money. Okay? And so if they do rotate some of those values, some of those income areas, defensive areas, there's only four of them, which is healthcare, staples, real estate, and utilities. Of those four, two of them are more sensitive to what the interest rates do. Real estate, and the second one really being utility. Now, take a look at that healthcare. This is not surprising. Remember, if all of a sudden you don't see those growth areas going up, think to yourself, you're just losing the purchasing power from inflation. Okay? If we kind of say, where might they go to? If we see some of these sectors like healthcare or staples or etc. making a new high or higher lows, someone is buying those and supporting those areas. Now, if we look at healthcare, we went up to a brand new high last week. We had one day down, and so far we've been tippy-toeing all over the moving average. Healthcare is still driving some of that performance. Now, some people might say, well, it's not as fun, it's not as volatile as technology. I understand that. But the biggest actually thing is sometimes you're trying to invest money where you have the greatest chance of potential benefit. If those technology stocks are actually going down in the sector, we're trying not to have as much capital in those areas to beat up the capital. Does that make sense? So we're trying to allocate the capital to where there are trends.
right, now, if you look at Staples, would have liked it better yesterday when it was actually at a breaking high. Today, actually, that Staples paring back a little bit. Breaking the trend? No. Now, when we also say, just real quick, the healthcare, we're talking about healthcare in a second. But if you look at biotech, check on that. If you look at pharma underneath an industry group, biotech, pharma underneath the healthcare sector, check on that as well. Now, what I want to do is, on a daily basis, I look down at really these three lists on a daily basis. Okay? Now, James, let me back up for just a second. James, do you look at the sectors every day? Yes. I physically put my eyes on each one of those sectors daily. Now, when people say that I can do it in 15 minutes, I can seriously take the class time and do it with you in 15 minutes. So in other words, if I went through this list, I'm going to do control spacebar, and what it's going to do is it's going to highlight that row and put a check mark. So we're not looking at semis. We're not looking at tech. Why? Well, because tech is below the moving averages. Next. IXV, we already talked about it. If I do control spacebar, it's going to put a check mark on that row. Transport, I take the check mark off because we don't see any strength in that area. Now, this is common transportation average. Okay? One thing you'd actually have to say is that keep an eye on the railroads. UNP, CSX, NSC, and so on. When I look at that next one, the S&P is the benchmark. Real estate, actually, real estate's stronger than you think it would be. Okay, utilities right there, not so much. No check. Industrial, nope. Financial, fighting back. Put a check mark. Gold, we're gonna put a check mark. Now, I personally didn't do that, but I think over time, people kind of see that as another way to kind of be a little bit defensive. I think that makes sense for many people. Discretionary, soap, sitting in the middle. Energy, we have flag. Energy is falling back. We need to talk about Exxon, we need to talk about Oxy, we need to talk about Schlumberger. Okay? There's the staple. But if we have a check mark there, take crude oil. The reason why I actually put in the crude oil sector list is obviously discretionary, if you will, less money spent on oil, gas, maybe go out to eat, go to the mall, online mall, maybe it's also, let's say, airlines, etc. So those are the lists. So now, if I go down to this next list, which is the Dow Jones, you're now going to see there's Merck. Now, Merck, we always have in the business account. It's not a bad problem to have. Put a check mark. Then all I'm doing just on my keyboard is click on the down. Now, the reason I'm going to put a check mark on ES is if you look on the right-hand side, and I'll zoom in here, I'm going to kind of draw a diagonal line for just a moment, okay? So when we're looking at this chart, what is it that we're really looking for, okay? So what I'm looking for is, are we bouncing or breaking out? Now, James, why don't you just pull up the list? We could, but I think there is value in looking at the charts on a daily basis. Nobody here should tell me they're too busy, okay? Because really, this is your business. This is your money, okay? So here's the deal. When we look at Goldman Sachs, a question for each one of you, is this bouncing or breaking out, yes or no? Now, if I said bouncing, the easiest way to see if it's bouncing, if we have a green dot there, that's close above the high of the low day. Is it breaking out? Well, we're also above the moving averages, so it would kind of lead us to believe it could be breaking out because we're above the moving averages. Now, if we draw like a mental line or physical line, we draw it out. There's a diagonal line. We probably draw another angle. It doesn't matter which angle we draw, there's a diagonal line. Now, a lot of times people ask me a question like, how do you find positions? Why don't you go down through the list that you're talking about? Now, one of the concerns that I have that happen to me is I can go down through this Dow list
and I couldn't read the blasted chart. I didn't have the education you did. We didn't have online courses back then. There wasn't any in-person events. There was no online webcast, nothing. We had dial-up internet, and we're using typewriters, or dang near it. Now, if we take a look at this, for our first example that we're going to do, remember, when we actually look at the material, excuse me, not materials, which, by the way, I want to actually include that. The materials, IXB, where'd it go?
Jamie, how long do you have to fix your steak? 30 seconds. That's not very long. That's right. Pretty fast. Wow. And what are you looking for when you're cooking your steak? You gotta get an idea of which steak you want to make it with. But you're also looking for ones that have good marbling. That remembering the fat in the meat, and that indicates it'll be a more tender sort of meat. You've got your steak here. Tell me why you chose this one. I was looking because of the white flavor. The loin, and I thought it worked with it. I mean, it looked good. Then a piece of meat. We're not able to touch them, but when you ask somebody to flip them, if you'll watch, the things will kind of hang. And if they're flexible now, they're going to be more tender. Good stick there for chicken. All right, until that. Okay? See you later. How about being here on the beautiful Gulf Coast to cook an NCA pie? I mean, here it's unreal. It's feels like a summer day. I left home yesterday. It was raining and nasty and dirty, and get out here. This has been beautiful today. Yeah, it's been gorgeous here. So this book is a little bit different. It's not during the day. It's going to be a night book. How will that affect things for you? Well, I will be light on time, so what do you think about your build with competitors here? You got about 50 people you're cooking again. Yeah, well, that's the thing here. It'll be a tough night, a tough day tomorrow. Excited though? Oh yeah. We're not cooked steak in a while, so we do barbecue thing, but yeah, looking forward to kind of digging the notes out, making my lines. We'll see what happens. It's 50 great steak here.
Where'd it go? I got to put that in the list. Where'd it go? Okay, right there. Now, I'm going to also include that in the list. Base materials. We're talking about basic materials that felt like something was missing. There it is. We're going to put a check mark there because that's precious metals. Now, when I go back to, let's say, the financials, you got to think, we're talking about commercial banks, regional banks, insurers, capital type companies like the SIBO, the NASDAQ, the CME, et cetera, et cetera. Okay. So when we look at the sector, it's not completely surprising that when I go look at the second stock on the list, there's a financial stock trying to break out. Now, let's start kind of with an example. Now, this stock, Goldman Sachs, is at $1,050. I'm going to go to the trade tab and say, just tell me where are we at in terms of a spread. And when we do this, we could start by looking at the average volume or the current volume. It's only at 500,000. Now, remember, we're only about 90 minutes into the market. We want average volume of 1 million. We can look on the price chart itself to see what that volume is. The current volume is 500,000, okay? When I go look at, let's say, the monthly options, the at-the-money strikes, I got a spread that we could drive a truck through it, okay? And this on this side, that's not being any nicer either. Now, if I go down, let's say, to the next month and say, well, what about these? $3 wide, and over here, about $4 wide. Options, now, you could. It just means if you buy it, you're probably, if you get filled, the chances that you're going to be upside down in the trade is extremely high. Okay. So we're going to go back to the stock tree, okay? And in this example, what I'm going to do is I'm going to right click on the chart. What I'm going to do is go buy custom with the OCO bracket. Now, I want us to first think about how much are you willing to risk, okay? Now, you got to be thinking about this because really, if you don't have any money to risk, then how are you going to invest, okay? So obviously, to risk something, you got to have some capital. Now, if we kind of come back to this, I'm going to right click on the chart, buy custom, and I'm going to go with the OCO bracket. Now, when we do this, some like to look at a target first. I'm a pessimist. So I like to kind of look and see, well, how much risk potentially could it be? And if we were to look at this and said support, we're going to look and see maybe about 1029-ish. If we set it below there, where some of you might be thinking, we're about $1,000-ish. Now, if we were to set a stop below 1029, okay, 97, less 2%, it's going to be 1,937. All right. No, if I type that in, 1,937. That's going to really be about $42 of potential risk from the entry price down to the stop. Just quick and dirty math, if we risk about $42-ish from entry to stop, on a stock that's about 1,051, percentage-wise, it's about 4%. What does that tell us? It tells us our stop could be tight. It tells us that the bounce or breakout is not so elevated off support that it's a higher percentage. Okay, now I got to risk something. Okay, this is risking about 4%. Target-wise, if we kind of said where do we see some resistance areas, I'm going to kind of put a marker right at about $1,100. Scott, aloha back. Okay, ever since Scott, Scott got me into these wine deals. Okay, now here's the deal: 1,100. Now, some people really look at that reward to risk a lot. Okay, some others don't. Okay, reward to risk, as far as the numbers, don't completely tell you the whole story. We're going to put the target at 1,100. If it goes to that price or higher, sell it. If the stock actually goes down to this price or less, sell it. Now listen to what I said, not what you maybe filtered. Stop. The bad part about the stop is it's a trigger to sell. If it goes down to that price or less, it's a trigger to sell, but we don't know what it's going to fill at. Now, could it fill at 1,937? It could. Could it fill at 1,007? Yeah. Could it fill at 1,000? Could it fill at 980? Yes, yes, yes. So the biggest actually thing is here, that's the con of the stop. You also have the other con of the stop is you can get the stock to go down to 1,937 and bounce right back up. This is why I teach protected puts. Because with the stop, if it goes down to that price and just stops you out and then bounces right back up, the trades could be over. Where if we buy a put, trade's not necessarily over because you have a contractual right to sell until the expiration. That's a difference, okay? That's a game changer for many. You should look, at least evaluate both and see what you would consider. What and why. And when. Now, what I'm going to do is I'm going to go back to the position size. We're about $6,200 if we take a full position. And I'm going to type in this. It's going to be about 5.89 shares. I'm not going to do fractional shares. I'm going to go a little bit less to about 5 shares. Now, we've done a number of these examples to know when you only see 5 shares, it's not telling the whole story. 5 shares on a stock that can move 50, 75, 100 points in a matter of days to weeks. So 5 shares is not telling the whole picture because we want to look at point movement. From this range, 980 to 1153, that's a lot of range. It's 170 points. 170 points on 5 shares, that's still more than you think. So don't look at that. You can't make anything or lose anything. We've shown many examples that that's not true. If I go confirm and send, we talk about the stop, it's going to be in the margin account.
send the order. Now, what I also want to do is let's go down to the next one. Now, if we go down to just real quick NVIDIA, I'm not going to do example of NVIDIA over earnings. If we go down and look at, let's say, IBM, that is still not really reversing out of the downward trend. The keyword is yet. Go to Mr. Johnson, the fifth one in the list. And notice this. Merck could be a bullish entry potentially today. We already have it, so we already have two positions. Goldman Sachs we just did. NVIDIA has earnings tomorrow. IBM doesn't have any setup right now. Johnson & Johnson was 5 stocks in. We got 3 trading examples. Now, if I said to myself, well, how do you find trading examples? I'm literally showing you. Now, sometimes you can be so blunt with what you're showing or telling. It just blows over someone's head. It shouldn't. It should hit you right between the eyes and say, man, do I really do this for myself? Why do we look at the Dow? Because A, they're the larger caps, the proven businesses and the models. They have big income statements. They have big balance sheets, and they have global exposure. They have high institutional ownership, a lot of stock volume, probably has a greater chance of option liquidity, among other things. Now, if I went back to Johnson & Johnson for just a moment, let's say the investor said, James, I want to kind of, I'm kind of thinking that maybe Johnson might continue to grind higher. Go back to the daily weekly chart. That 3-year weekly chart looks now. If I said to myself, James, it's too high. Okay. Now, I want you to think about when your wife or your husband met you. She or he probably thought him, her. Because you are at an all-time high. Of course you were. Now, she or him, good thing they came up to you because you were at an all-time high and you took your spouse to a higher high. That's what friends tend to do. Now, if we take a look, don't act. That's not what happened because that's the truth. Now, if we take a look at this, I'm going to go back to, let's see, now we don't know if the option. Let's go double check. We're going to go look at the trade check. What's the current 1.1 billion? Now, better than what we saw in Goldman Sachs. What's the at the money volume on really Johnson & Johnson? That's 50 cents wide. Not the greatest. Over here at 65 cents wide. On the September is not the greatest. You come over here, 50 cents over here on the Octobers, and we got about 50 cents here. This is a second stock in a row we've seen where the options, they're wider than what we like to see, which is 20 cents. Yeah, darn right, Jay Richardson. Jay Richardson says, JB never. JB never says, look, I mean, when you run into millionaires, you're always thinking higher. Why not? Welcome to Compound. Can get salary. The biggest actually thing is when we take a look at the say Johnson & Johnson, we're going to do a second stock trade. Now, I would like to do an option. Currently, I just don't have anything where there's liquidity. Okay? And at least on the at the money strikes, when we're looking at kind of see is there current liquidity. Understand this liquidity can change.
Has an emo face.
Now, I'll leave it at that. Okay? What I'm going to do is going to go buy custom, and I'm going to go with OCO bracket. Now, what I'm going to do is in this IRA, the margin account has shares, but in the IRA, no. Now, I don't know if you're like most people, but many people are saying, James, I want to get. Now, we talked about this yesterday. Today is the first day at Johnson & Johnson. We buy today, ex-dividend date. Now, what is the ex-dividend? So this is ex-dividend date 8/25. What does that mean? What does that even mean? Ex-dividend date. What does that mean? Well, if we buy the stock today being August 25th, we do not get the dividend. Okay? If we buy the shares from a seller, the seller would get the dividend. The buyer doesn't. We bought those shares yesterday before the ex-dividend date.
You come.
Okay? why we would get the dividend. So the ex-dividend is the first day it trades without, if we are the buyer, the first day it trades without the claim to the dividend.
Go hide.
So we buy the shares today. We're thinking that that stock would appreciate because the upside is not current dividend. You kind of missed that. Bought it yesterday. We're going to buy it again today in the IRA. We're going to actually right-click on the chart. We got 273.44. Okay, I'll let that float. If we unlock it, it's moving as we talk. Okay, the price is moving. Now the target, I need to check the target. Stop on this. I'm going to kind of set that diagonal support. Now you might say, James, you lost your mind. Well, kind of depends. Okay, how tight do you want to set the stop? Their stop support 269, really tight. If we took the lower end, 259, we're allowing to come back inside this apex of the ascending triangle to try to test. Let's run the numbers, okay? So don't say I'm crazy, okay? Run those numbers and then we'll see kind of if we're buying a little elevated. If we say that, hey, I'm going to set the stop below 259.76, less 2%, well, it's going to be 254. Now, if we buy the shares at 273, okay, 52, less the stop of 254.56, the risk per share is $18.96, assuming one. Then we get stopped out right. We put an asterisk on that. That doesn't always happen. If we buy those shares at 273.50, the percentage forecasted risk is 6.9. Why is it a little bit more elevated? Well, because we're not setting the stop underneath the first support. That's why. Now here's the deal. It doesn't matter 2007, 2008, 2018, 2026. We're trading trends that are trending, bounces that are bouncing, breakouts that are breaking out, and moving average crossovers that are moving average crossovers. Okay? So what I'm going to do is I'm going to put that stop at 254.56, and I'm 254.56. We actually talked about the cap or the position size. We're going to put that we could actually do, I think the capital size we've been doing is right around about $7,500, about 27 shares. Once I know that, I can just type in 27 shares, not a fractional number. Okay, there it is. And the target on this. Now, one thing that we could actually do is I'm going to kind of set this target based on shorter measurements, resistance, down to a support area, not wicks, support. If we go down to the wick, that's a low. We went up to the upper shadow. Again. That's not resistance. That's a high. Okay? Now, if we drew this and said, where might it try to go to? The first targeted area, 282. The second targeted area, 291. Now, what I'm going to do is I'm going to set that kind of, maybe, we set a target at 282. Okay, it's kind of maybe the first target. 291, second target. I'm going to kind of put it in the middle, 286.50. Okay? So if you said, I need a little bit more than that to offset the risk, I'm going to put it right in the middle. Now, 161 is the fib, 200 is the channel width added on top of resistance. That's what that is. 200 is not Fibonacci. Okay? So there we go. Data GTC, data GTC. Here it is. So first trade that we actually did was Goldman Sachs, a stock purchase. Second trade we're actually doing is a stock purchase on Johnson & Johnson. Now remember how that stop works. If it goes down to that price or less, it could get filled at a lower price. Remember that MRK market. The biggest actually thing is that it's a market order. Okay? It's going to fill the market, whatever it can get filled at. Confirm send. There it is. It's in the IRA account. There it is right there. Send the order. Now, what I need to do is I need to go back to something just real quick that's going to dovetail into what we're talking about next. Now, we did an example of, and by the way, when people talk about it, I like to learn about the market, etc., whether it's trading or investing, it's not just putting positions on. on managing what you got. Now, one of our trade strategies that we've been doing over and over again is short put verticals and long call verticals. Why? Well, these are really strategies that might be helpful when stock prices are potentially higher, or maybe you can't buy as many shares. You're also trying to, for example, maybe have a defined risk on the trade outside the stock going to zero. Now, in this Apple example, we bought the 350 call, which is a bullish strategy. Second, now when you buy a call, you gotta pay for it. Now, if you buy a call, that just means up if you buy the call itself. If we buy the call and we sell the higher price strike, well, we collect the credit and it decreases the debit overall on the position. This is known as a long call vertical. Now, why do we bring this up? Well, because we're sitting on 93% of the maximum gain with 24 days remaining. Now, I think it's very simple. I say if you can get 30% the first 100 trading days, that is a home run grand slam. The investor might consider taking it or rolling the position. If you get 65% with more than 20 days remaining, that's a home run grand slam. Consider taking it or rolling the position. If you get 80% ever, it is a home run grand slam. Okay? Now, the only way you get 100% is you got to get the stock to go way above the strike prices. In this case, the become calls. And you got to get the time to get closer and closer to 0 days to expiration. Now, what we're going to do is we're going to right-click on this, create closing order, and we're going to buy it back. Now, the reason why I'm bringing this up is because when we go to look at down at the Dow, Apple is in the Dow. Okay, now if I go down to, let's say, Cisco, is it bouncing or breaking out? Well, it's getting a little crossover. Is it the strongest trend that we've ever seen? No. It actually kind of looks like it's made some lower lows. We're going to say skip. Okay? Now, if we go down to Amgen, per Jay Richardson, is grinding to the upside. I think we're going to get some No, not talking about Boeing. Boeing is at the support, and really industrials are underperforming right now. Williams. This has always made me wonder, what do they put in the table? Okay? Or are they just cutting the number of shares with the EPS on fire over time? I don't know. The biggest actually thing is, if you look at this, someone said, James, could this be actually crossing? Yeah, and the first sign of cross is price getting above the short-term moving average. It has. Second sign of bullishness is the short-term moving average actually turning green. It is. Third sign is the moving average crossing over, or that 20-day moving average green. We're right in the middle. Note that. I'm not going to do that as a trade example because I want to talk about some of these others. Microsoft. Yeah. Now that kind of looks a little bit more bold, a little bit, than SHW. Now, when you look at Microsoft, underneath you got the tech sector, right? Underneath there you got software and hardware. Software is held in there. Now, let's kind of talk about examples. Well, I mean, we just pulled up the sectors. We visually put on those sectors. Except whenever we like to go see examples. Now, James, can you bring up the sectors and the ETFs? Could you imagine? Okay. Now, if we took a look at, let's say, Microsoft, let's do something. So what do but I want to be a little bit more conservative. If we take a stock position, the break even is what we bought the stock for. If we buy a long call, take the strike, add the debit, that's the break even expiration. That long call, we tend to have to get some movement to get to the break even by expiration. Hopefully. If we said long call vertical, break even is not as high as that long call vertical. If we did a short put vertical, well, you take the strike that you sold less the credit. So of the strategy we talk about, which of those are a little bit more forgiving? The short put vertical, okay? Now, if we went into the trade tab for just a moment, what's the current volume? 6.7 million. Now, the higher the volume, we're kind of thinking about in this case that if that volume's higher, the bid-ask spreads might be a little bit better. They might be. We have to double check. If I go look at the at-the-money monthly options, 40 cents. Now, you got to understand something. This is a couple $100 stock. We would like to see the bid-ask spread no wider than 20 cents, but on these bigger ones, it might be maybe, let's say, 20 to 50 cents. On the bigger dollar stocks, north of 300. Over here on this side, you're going to see it's 60 cents right now. Now, James, wait. Do you have to, maybe could you look at other strikes to kind of see if it's something, especially you said the short put vertical? That's 30 cents. That's kind of more in the realm of what we're looking at. The 480 has 40 cents. So there are some examples. If we're doing a short put vertical, the spreads are kind of more in the realm of what we're looking for. Okay? Now, if we take a look at this, what I'm going to do is I'm going to go down and sell. Now, here's the deal. If we sell, and I'm going to look at this, we sell the 485 versus if we sell the 480, which one is more aggressive? You could almost figure this out and know nothing about the stock market. If they're going to give you more to sell it, the 485 is probably more aggressive because they're giving you more premium. If they're giving you less premium, the odds are probably more in the investor's favor that the stock could be above the break even at expiration. Now, let's say you said, James, I want to go with the 480. I don't want to sell so close to the current price. Well, if we sell the 480 and then we buy, let's say, the 475, this is a $5 wide spread. Double check. So if you look at the spread width, I should say the bid-ask spread, excuse me, 50 cents. If we go look at, let's say, the bid-ask spread on the 475, 40 cents. Could we go look at, let's say, the 470 strike? I will if you want to. The 470, what is it if you want to do more less contracts and just a wider spread? That's 30 cents wide. So now, if we said I want to do a $5 wide spread, 480, 475. If we said, James, I can risk a little bit bigger amount, if you're looking at the 480, 470. Okay, now PS says, JB with the fixed low, would you consider the October strikes? P, I'd consider it. Why did we start here? Because we always start here because, well, we have more than 20 days expiration. If I go look down at the October, okay, and say, what are these showing right here on the at-the-money strikes? Those are 60 cents. Those are 50 cents. And if we go look at, let's say, now, if I look at the out-of-money strikes, that's going to be about 65 cents, 35 cents. Why would someone go out to the October? They're trying to give themselves a little bit more time. Now, if someone did the Octobers, they're probably saying, look, I'm not going to set a conditional order to get out. They're saying I'm planning to hold.
Why play Rakan's support? Well, he is very mobile with 3
or to a
dashes. He brings multiple AoE lockdowns. He easily appeals for his carry, and he's slippery and difficult to kill. However, he does have high cooldowns in the early game, and missing your W does make you feel pretty useless. Rakan's passive is periodically he grants himself a shield, and when he hits an enemy champion with a basic attack or ability, it reduces the cooldown of the shield. In addition, if Zaya's in the game, if one of them are backing, you can back with the other one to back together. Rakan's Q is a straight line skill shot, which deals damage to the first enemy hit. If the target was an enemy champion or epic monster, Rakan gets a circle around himself. Then, after 3 seconds, or when he walks near an ally champion, Rakan heals himself and a nearby ally. Rakan's W dashes him in a direction and places down a circle on the floor. Then, after a short delay, he deals damage to all enemies in the circle and knocks them up. Rakan's E dashes him to an ally, granting them a shield.
$10 spread, less
Hans W dashes him in a direction and places down a circle on the floor. Then, after a short delay, he deals damage to all enemies in the circle and knocks them up. Rakan's E dashes him to an ally, granting them a shield. He can then reactivate this ability in the next 5 seconds for no additional cost. Also, if he's dashing to Zaya, the range he can dash is massively increased. Rakan's ultimate causes him to start sprinting for 4 seconds, gaining a massive amount of bonus move speed. During this time, if he hits an enemy champion, he deals damage to them, slows them, and charms them. When he hits an enemy champion, he slightly extends the duration of this ability, and the first time he hits an enemy champion, he gains an insane amount of move speed. For combos, a basic trait is to use them and charms
for lowest and for middle.
This move speed.
And H would be high.
Rakan's ultimate causes him to start sprinting for 4 seconds, gaining a massive amount of bonus move speed. During this time, if he hits an enemy champion, he deals damage to them, slows them, and charms them. When he hits an enemy champion, he slightly extends the duration of this ability, and the first time he hits an enemy champion, he gains an insane amount of move speed. For combos, a basic trait is to E ultimate ally to get in range to W your opponent. Attack into Q, then attack again before using E to easily disengage. Your all-in is the ultimate into E and W. They'll be charmed, which guarantees your W into an attack in Q before Eing back out. And a longer range engage combo by yourself is to W into your ultimate. Attack into Q before running your ultimate through multiple people and Eing out if needed. For matchups, Rakan is great to engage support, having the ability to not get locked down while easily peeling his carry. However, he can struggle with champion to easily interrupt dashes. For runes, take this. Guardian makes your lane much safer. For build order, side World Atlas and puts into T2
order. Some of the stocks that we're going to watch is Apple, which we took the profit in, but keep an eye on that. That actually coming up, what, a week and a half from now? They're actually having the September announcements of the new products. Amazon is kind of sitting right on the cusp of a crossover itself with a bullish MACD divergence. Visa, well, one thing interesting about Visa is it doesn't necessarily matter what you buy. They're going to get that 1 or 2%-ish or a percentage of the purchase amount. You got Visa that broke out yesterday, not much of a pullback today. MasterCard, that horse is also there as well. American Express is also not reversing yet. The other one that's in the card space, the insurer space, Travelers, which by the way, it's in the Dow. What do you know? So it's kind of actually funny if you actually look at the Dow, how many setups are in the Dow. You could probably count at least 5, 6, 7 trades out of 30 that are showing bullish setups. Now, in closing here, I want to kind of make sure you, the last one to kind of make, just close out with is Netflix, okay? Remember, Netflix is one we've been watching the last couple of days, traded twice. That is another one that's left some chocolate chip green dots all over the chart, today being another one. Now, something I want to make sure that you're aware of is actually coming up, and let's show this. This weekend, we're going to be in New York doing the advanced options, the 28th and 29th. Some of you might not know that coming up September 19th, we have a one-day event in Scottsdale, Arizona at the Phoenician, and that's going to be September 19th from 9 a.m. to 4. One-day event. I'm going to send you this link so that way you can plan where you might be in the country. This also goes into 2027. So make sure you're also looking at that schedule as well. But I wanted to highlight absolutely that market drive and this weekend in New York City, because those are the next two events. Join us. Also coming up just real quick, the next class is going to be Getting Started with Options. Cameron May will be teaching that. And I'd also like to say thanks to Scott Thompson for answering those questions in the chat as well. Now remember with what we discussed here today, we did 3 trade examples. Talked about all investing involves risk. And also remember when we talk about examples, they were just that. 2 stock trades, 1 option trade. And also talk about some stocks you can keep an eye on as well. Stay tuned for Camera May coming up next. If you did not subscribe yet, do so now. If you enjoyed today's video, click that thumbs up so others can find it on YouTube as well. Thanks again so much. I'll be back tomorrow, same time, same station, talking about trading growth and value. Take care. Bye-bye.
The road to ruin. I've walked it once before.
Yeah, next year. Okay. I know.
An Azakana stars. I will take no joy in cutting you down.
Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager of training and business education here at Schwab. And this is Getting Started with Options. And today we are tackling a big obstacle for particularly for a new options trader. And that is, there are dozens and dozens and dozens of option strategies to choose from. So how might a trader choose just one for their convictions regarding current market conditions? Well, today we're going to be going through a three-step process, asking ourselves three big questions that might provide a lot of clarity for which option strategy a trader might select. I think it's going to be a good discussion. Before we get to that, though, we first of all say hello to everyone who's already chatting in out there in YouTube. Great to see all the familiar names. Hello to anybody that might be new. But hi there, Lawrence and Paul, Eva, Waylon. Who else do we have? George, Miralai, Gary, Marcus, Richard, Mark, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream audience. If you'd like to be here, we kick things off promptly at noon on Tuesday. Now, I also want to let my live stream audience members know that my very good friend Kevin Horner is going to be hanging out with us today. He's going to be keeping an eye on the YouTube chat, and he's going to be catching any questions that come in. If I can't get to those questions, Kevin's there to pick up the slack for me. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn, so you can find Kevin on X at Kevin Horner CS, you can find me on X at Cameron May CS, or you can jump over to linkedin.com/in and then /Cameron May CS. That's my handle there. You can give me a follow, and if you reply to my post on social media, I just reply to you. All right, but let's get into this discussion of selecting a single option strategy out of the dozens and dozens and dozens available out there. Of course, as we do, we need to consider the risks associated with trading options. So bear these important disclosures in mind. Options carry a high level of risk. They're not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right, so with that said, let's set the agenda for today's discussion. So we do have a big issue to tackle, and that is lots of strategies to choose from. How might a trader pick one? So what we're going to do today is we're going to look at current market conditions through the assistance of three charts that may help us address three big questions that might help to whittle down the range of option strategies that one is selecting from. So I'm going to outline what those questions are. We're going to use those three charts that might assist with answering those questions, and that hopefully will guide us toward an example trade for the day. Just one strategy to select out of all those potential strategies. So let's go right to the Thinkorswim desktop platform. And the first thing I want to do here on the Thinkorswim platform is to outline these three big questions, this three-step process for narrowing down the field of potential strategy candidates. So question number one, I want to determine are current market conditions and are the conditions expected for the time frame of the trade bullish, bearish, or neutral? That's going to be question number one. Number two, does it appear to be more of a buyer's market for options or more of a seller's market? And number three, is the trader looking for a strategy that offers very highly reward potential that they intend to leverage, or is there a preference for higher probability? There we go. So those are our three big questions. And just answering these three questions, different strategies are going to suit the answers to these questions very differently. So we're going to start off with theoretically dozens. There are dozens of bullish strategies, dozens of bearish strategies, dozens of even neutral strategies. So we're going to start to whittle those down by, first of all, addressing this first question. And when I say bull, bear, or neutral, we might want to ask ourselves this about current market conditions, because, and specifically I'm talking about the stock markets. Because let's put ourselves in the shoes of a trader here who's about to go out and place an options trade. And maybe they're looking out to maybe this September 18th expiration. So over the course of they're planning a trade here that might run about 3 weeks. Well, what's their outlook for markets? Are they expecting the markets to be higher or lower or primarily neutral for that time frame? Because if we're in the habit, no matter how gifted we believe we are with options trading, if the trader is habitually placing, let's say, bearish trades, and the markets in general are persistently bullish, that can be tough. As good as the trader might think they are, that can be a difficult prospect. Now, on the other hand, if we're placing bullish trades, how many of us have noticed this? If the markets are cooperative, it seems like those bullish trades, I don't want to say can't miss, but boy, it seems to help a lot, doesn't it? Yeah. So just getting market conditions dialed in might be the biggest of all the three steps. So let's look at the stock market. Let's ask ourselves this question. Right? Let me frame it this way. Let me give you an assignment. Let's look out here from today out to that September expiration, and putting yourselves in the shoes of our trader. Do we think that the S&P 500 is likely to be higher, lower, or mostly sideways?
I come one step closer.
Let's start to gather some technical evidence here. Is there anything that catches your eye? One thing that a trader might note is that there was a price ceiling around that 7,600 level for this stretch of about 3 months. Looks like the S&P is just really reluctant to get above, stay above about 7,600. Let's throw in a line there. How about there? You can see what I'm talking about. I'll get that as close to 7,600 as I can. That'll work. But you can see how, the S&P just really never settled above that until this big, strong day there on August 4th. It pushed up and through, and an assumption by some technicians might be that that's likely to act as a new price floor or a new overall prices floor. Not a guarantee. Farewell. And that might be one piece of technical evidence for those that use Fibonacci's. Let's throw on a Fibonacci here. Let's go to this recent high. Click right up there. Let's move to the bottom. And interestingly, our 50% line is settling right in at that level. If you don't know what a Fibonacci is, you can actually learn about these. Just go to our channel. If you're new to our channel, welcome. It's great to have you here. Make sure that you're subscribed. Just hop down below the video, click on the subscribe button. It only takes a second to do it. It doesn't cost anything to do that. But our Trader Talk channel on YouTube is where you can join these live streams. You can find playlists of previous webcasts, or you can even do keyword searches for topics of specific interest. So like if this is your first exposure to this technical approach known as Fibonacci, let me just type in Fibonacci. You'll see right here. Several discussions I've had in the past. Here's one that I would suggest for those brand new to this. Beginner's Guide to Using Fibonacci's to Trade Stocks. That'll explain what this is. But it's basically just a tool that's sometimes used by technicians to identify potential price floors and price ceilings when they're not otherwise obvious. Okay? So I'm going to remove that. I'm going to unplug this. Overall, though, let's just say that our trader suspects maybe after this strong move to the upside, there's been some profit taking, and possibly the S&P 500 and the component stocks have kind of settled in. And let's say that the outlook, our traders expecting prices to go higher from. Is that a guarantee? No. But if it does, that can really provide a bit of a tailwind to a specific category of our strategy. So what we're going to do in answering our first question is, let's, for today's discussion, remove bearish strategies from consideration and neutral strategies from consideration. And that is a massive step forward in narrowing the field of potential strategy candidates. If some are bullish, some are bearish, and some are neutral. We just took about 2/3 of those strategies out of the equation just by addressing this one question. Now, what we'll probably want to do is make sure that our outlook for our individual stocks that we select for trading options on, we want to make sure that that is consistent with this bullish outlook. All right, but that's question number one. Bullish, bearish, and neutral. Big assist, probably the most helpful in narrowing our field of candidates. However, there's still lots of strategies left to choose from. Now, about half of those are going to be buying strategies, about half of those are selling strategies. So let me explain that. If we're bullish on the market, stock, well, as a basic, one of our simplest strategies, or just the least complicated, is we could buy a call. That's bullish. Or we could sell a put. That's also bullish. So does it appear to be more of a buyer's market or more of a seller's market? Now, we can do all sorts of variations on the theme of buying calls or selling puts, but both of those are bullish strategies. So how about we go look to see, does it appear to be more of a buyer's market or more of a seller's market for options right now? That might help us narrow the field of candidates further. Let me throw that question out to you again. What do you think right now? Does it appear to be more of a buyer's market or more of a seller's market? I know a lot of you feel pretty comfortable in answering that question right away, especially as we look at where things are right now and where might the trader expect things to be, let's say, a few weeks from now, as that September 18th trade time frame is closing out.
Destroyed a turret.
Buyer's market or seller's market? Well, how can we check on that? For our first question, we were checking on stock market conditions. This second question is really more specific to options market conditions. So we're going to switch our chart to a chart that might assist with that. And this is the VIX. VIX is the chart symbol. And this is a chart of the anticipated volatility of the S&P 500 for 30 days. Why does a trader care about volatility? Because volatility has a large impact, can have a large impact on the pricing of options. Just generally speaking, if this chart is high, that kind of highlights times when traders are seeing a lot of volatility in the S&P 500. And when there's a lot of volatility expected, that can drive options prices higher. Speculators might see potential in all that volatility. Hedgers might see risk. Either way, speculators might buy more contracts in an effort to take advantage of volatility. Hedgers might buy more contracts to hedge positions in their portfolio. But demand can get pressed higher in highly volatile conditions, even just when the expectation is highly volatile, and options prices will tend to rise. So when this chart is high, options prices tend to be high across a lot of strikes and a lot of stocks out there. And when this chart is low, options prices tend to be low. If we just look at this through the lens of buying versus selling, we typically like to sell things when prices are high or sell things when prices are low. Higher volatility is typically described as a seller's market, especially if it's high and falling.
Rampage.
When we have low and rising volatility levels, that can generally be described as a buyer's market for options. And that seems to be where we are right now. It doesn't mean that we can't go lower. However, there hasn't been much. Let me just draw a line in here. Let's go right to where volatility levels are right now. Let's just draw a line back to the last 12 months. And you can see, really, volatility has not settled much below where it is right now. Options prices, in general, have not been much lower than they are right now over the last 12 months. Maybe for short periods, maybe a little bit lower. So Eva says you would say it depends on the individual underlying. Can. Yep. With this, just like with the S&P 500, if we say, ooh, it looks like the S&P is bullish, therefore can I go out and just trade any old stock because they're all going up? Nope, it's just a sort of getting fingers on the pulse on what's generally happening. That would also be an accurate statement for the volatility index. If volatility is low, that might mean that most stocks, most stocks are a lower price than most of the time. Overall, let's say that our traders have looked at the S&P and determined bullish time frame. They've looked at the price and they've determined that it appears to be more of a buyer's market. So, bullish, well, buy calls or variations on that theme, that would be bullish. Sell puts or variations on that theme, that would be bullish. But we're just not going to do any bearish or neutral strategies. That's narrowed the field down. Second question, looks like buying calls or variations on that thing, more of a buyer's market than a seller's market. All right. Now, and again, that's under the assumption that volatility levels or anticipated volatility levels rise somewhere higher than they are right now. That can provide a tailwind again to the prospects for this trade. So we've narrowed down that field substantially. No bullish, no bearish, no neutral, just bullish. Among the bullish, we've just eliminated half of those, and we have our buying strategies. Well, among those remaining bullish buying strategies, there are some that are going to be inherently higher reward but low probability. There are others that are going to be inherently lower reward, are high reward strategies, but higher probability. So this might be the final question that our trader asks them. What am I looking for? Do I prefer high reward, but am I also open to the idea that these high reward trades don't work out as often? Or do I prefer higher probability, more frequent success, but maybe less rewards for being successful? That's a decision up to the trader. It can change from one trade scenario to the next. It doesn't have to be absolutely consistent from one to the next. But let's do a comparison. And for this one, we're going to use a third chart. SPX was our example chart number 1. VIX was our example chart number 2. Our third chart is just going to be the stock. So I'm going to bring up as our example trade for the day Netflix. Let's say that our trader has been looking for a stock whose outlook, at least for the time frame where I intend to trade, seems to match their expectations for the S&P 500. In other words, they expect the stock to go up. And some technical evidence supporting that sort of a premise here. Again, not a guarantee. But Netflix has gotten kind of punished over the last 12 months. It's not been one of the hottest stocks. It was just very recently making lower highs and lower lows. However, since that last earnings announcement, it's turned a bit of a corner. And you can see over the last 6 weeks or so, we've been making higher highs and higher lows. Maybe I ought to say that, maybe 6 weeks, maybe 5 or 6 weeks, we'll say. We've started a potential recovery process. Could this be this stock starting into a new extended upswing? Possibly. Now, the trend in the short term seems to have strengthened. But also, we've recently pushed through previous highs. It looked like there were highs right around that 79 level, where the stock kind of struggled to advance. And then just a week ago, we pushed up on a particularly strong candle day, and that looks like it might be a new price floor now. At least it's acting that way over the last few days. And even today, getting some strength when the markets are kind of having a ho-hum sort of day. So let's just say that our trader thinks, it's their premise here, that Netflix is likely to go up. Now, they have to make this final decision here, though. There are some traders that might look at this scenario and say, boy, it looks like there's some room to go. This stock could just continue to run like it did over the last few weeks. Maybe if it does that for a couple or 3 more weeks, we could go from $82 where we are right now price. We leverage that with, let's say, just a long call option. That should carry substantial upside reward. So maybe the long call is on the table for consideration. Let me ask this question. Got two questions for you about the nature of long calls. Number one, what's the ultimate reward potential of a long call if we just buy a call option? How much can theoretically be made? 3 weeks, 6 weeks, 2 months, whatever. It's unlimited. If we buy a call, the higher that stock goes, the more that call can theoretically make. It has a strong reward potential. Some traders are really attracted to that. And if they really think that a stock is going to go for a substantial run, that may tilt the scales for them toward this higher reward scenario. That might be the strategy they prefer to choose. However, what about the inherent probability of long calls? I can make a statement of fact here. Long calls are low probability. So are long puts, but we're talking about calls today because we're bullish.
Your turret has been
If we
destroyed.
buy a call option, doesn't matter which stock, doesn't matter which strike, doesn't matter which expiration, that call starts off with a lower probability of success than failure. Because of a couple of reasons. Time decay, the difference between the bid and ask price is what's called slippage, right? At the start of a trade, it also is present at the end of a trade. If we go to close out a long call, we can see some slippage just in the liquidity of the option. But in any case, I don't make absolute statements very often, but in my experience, if you can find an exception for me, all long options are inherently low probability. So lots of reward potential, but the percentages from one trade to the next are not necessarily in the favor of the trader. Now, I know that I've heard some traders make the argument, yeah, Cameron, yeah, but that's not right because I'm really good stocks and picking strikes. That doesn't change the math of the probability of the trade. Yep, Eva says long anything is generally low probability. Fairly accurate, Eva. Depends on what anything is, because I'm going to show that we can actually use a long vertical spread that's high probability, or higher than just buying a long option. We can just call it, if we define it as better than 50-50, we can say that we can structure a vertical spread could be higher probability.
Is not for the weak.
But let's do a comparison here. Let's go to our trade tab. Let's say with our, let's see, where was our support? It's at 79. What if we were to buy, let's say, an in the money call? Let's go down to maybe like the 77. And let's look at maybe buying the 77 call. That looks like that's between 5 and 6. Let's say that we were able to buy that $5.95. Oh, yeah, you're exactly correct. Yep, yeah. We can say, if it's just a long option, no short options involved, just buying those options, yeah. Those are inherently low probability, so you're exactly right. Yeah, if we buy that $77 call, looks like it might cost us, I'm going to say it might cost us $6. It actually just went up a little bit in price.
Your turret has been destroyed.
Anyway, if we buy that at $6 and the stock goes higher, well, we lock in the right to buy shares $7 per share. And if those shares go to $90 per share, we still have the right to buy those shares for 70 cents. If those shares go to $100 per share, we have the right to buy those shares for 77 through the 18th of September or for the next 24 days. That would be the deal. But from the moment we place that trade, time decay kicks in. Boy, it keeps going up in price. That makes this look good if only we were already in it. Anyway, unlimited reward potential, lower probability of success. Now, let's modify this a little bit. Let's say example trade A would just be our long call. It has unlimited reward. Actually, let's reward potential. I better get the word. It's unlimited. But the probability is low.
Your inhibitor has been
Let's look at
destroyed.
example trade B.
An enemy has
Long
been
call,
slain.
vertical spread.
Shut down.
Let's stick with that same. Expiration. Let's outline it this way. Let's say we're going to buy the 18th of September.
An ally has been slain.
$77 call, and that is it still trading around $6? Look at that, keeps creeping higher. It might be $6.10 at this point. But let's compare that to a long call vertical spread. Just to be consistent, I'm going to use the same strikes, or the same strike. Let's look at buying the 18th of September 77 call for 610, but at the same time, let's sell another call to create a vertical spread. So the 77, how wide should we go? Let's go a couple of bucks. Let's actually go to that 79. That's where our strike, that's where our support is, $79. And how much would that cost us right now? Somewhere between 460 and or how much can we sell that for, I should say? Somewhere between 460 and 470. Let's call that 465. So we sell the September 79 call for 465. What does that do for this trade? Well, it does two things. It dials up the probability, but it reduces the reward potential. What is the theoretical gain on this trade? In other words, the potential reward. Well, if we do this vertical spread, we're paying $6.10 for the right to buy shares for $77, but we're accepting a payment of $465 or $4.65 that obligates us to maybe sell those shares for $79. So if these contracts, if we exercise our right to buy for 77 and someone else assigns their right to buy those shares from us for 79, that would be a $2 reward minus how much did it cost to set this trade up? 610 minus 465. It cost us $1.55 to set this trade up. Yep. How much does that leave us for profit potential? 45 cents. Is 45 cents less than unlimited reward? Yep. That's a whole lot lower reward, but also our probability is in the favor of the trader here. You might think, Cameron, why would anybody settle for 45 cents? Sounds so paltry. It sounds like it could just easily be dismissed. Well, actually, this is still a relatively substantial reward potential compared to how much we have tied up in this trade. How much is this trade costing us net? 610 spent, 465 received. This is a $1.55 trade. And if this trade goes well, we might make 45 cents on a $1.55. I don't know about your math, but mine says 45-cent return or reward on a $1.55 is a 29% return in 24 days if this trade works out. It's not that this is a tiny trade, a tiny reward potential. It's actually a very high percentage reward potential, but it's certainly not unlimited. Okay, so what's the actual probability here? What's the probability of making our full reward? Well, in order to do that, we need the stock to be above $79 as we approach that 18th of September expiration. If it helps, we map this out on the chart. We have one strike at the $79 level. Let's draw in a second line at the $77 level. That's our other one right there. If that helps to visualize it, these two lines now represent our two contracts. And where we need the stock to be as we're approaching the 18th of September is above 79. We need it to be up here. It doesn't matter where. And if you'll notice where the stock is right now, it's above 79. And it's actually been getting higher above 79 as we've been talking. So if the stock goes up from here, if it goes up, if it goes sideways,
to Summoner's Rift.
even if it retreats a bit, as long as we're above 79 as we get toward expiration, all of those lead to most likely the same outcome, and that is our maximum gain. If the stock's up here at, even if it just goes sideways, if it stays at 82 bucks, up, down, sideways, whatever, if it's worth more than $79 and someone has the right to buy shares from us for $79, are they going to do it? Yep. Almost, well, very few exceptions. At or before expiration, the other trader says, Cameron, I want those shares for $79 because I can sell them somewhere else for 82 or 85 or 90 or whatever. Great, we sell them the shares. At the same moment, we buy those shares for 77. Buy for 77, sell for 79. That's a $2 return of value on a $155 investment, or in other words, a 45-cent buy. That is a high probability outcome. That's probably what's going to happen. I can say that. If we look at our trade tab, there's actually a number that gives us the mathematical probabilities of this outcome. Let's look at the delta. You see the delta here next to our 79? Delta can tell us a couple of things. It can tell us how much the option might change in value as the stock goes up or down $1. But it might also tell us the probability that a contract expires in the money. Or in this case, there's a 72% chance that the stock is above $79 at expiration, and this trade works out. So if our definition is high probability means better than 50-50 chance of maximum gain, there's a 72% chance of maximum gain. So this is a high. This is a high probability outcome. There we go. So we can just say that, depending on how this vertical spread is structured, we can make this into a high probability trade. Now, we could have selected other strikes. I'm not going to do that today, but vertical spreads are highly customizable. If we wanted to dial up the reward potential to be more than 45 cents, we might need to choose some different strikes that also will reduce the probability of the trade. That's the way it goes. There's a teeter-totter effect. But which one is the right choice here? Here's what I want to throw out as the bottom line question for our trader who just has this final question to answer before they go place the trade. Should they go for the higher reward? Because if they buy a call and the stock goes shooting up, the one who did the vertical spread might be thinking, I got to settle for 45 cents. In this case, if they really want that unlimited upside potential, but they're willing to accept the fact that there's a lower probability of generating profits just by buying calls, they might go for the higher reward. Another trader though might say, Cameron, I like the probabilities here. 72% chance that I'm going to make 45 cents on my $1.55 or a 29% return. That looks good to me. Willing to draw the line in the sand, 29% adequate for me. I prefer the probability of the trade. That's exactly right, Paul. The right choice is the trader. It might come down to how convinced are they that the stock is going to make the move that they're anticipating. If they're highly convinced, maybe they take the risk, go for the lower probability, but for the higher reward. If they're a little less convinced, a little bit iffy, they choose this other one. Now, I'm going to go place this trade, and actually what I'll do today, I'm going to go for the higher probability trade. We're going to do our vertical spread today just for our example order. But I do want to try to take some of this pressure off. I know that it can feel like we have all of these different strategies to choose from, and I have the pressure of picking exactly the right one. Not necessary. With both of our traders, if trader A chooses to buy the long call and trader B chooses to buy the long call vertical spread, and then the stock goes ahead and blasts off, who's going to make money here? They both will, most likely. Yep. The long call trader might make more, but it's not like the long call vertical spread trader completely got left in the dust, didn't make anything. They both worked out. Matter of fact, if we just bought the stock, then the stock went up in price. We made money there too. It's just that there are lots of different bullish strategies that would very likely do just fine as long as the stock behaves bullishly. It's if it doesn't behave bullishly, if it starts to falter, time decay kicks in more, fewer of those strategies are going to work. The more aggressive strategies are probably going to not work. The more conservative strategies with the lower reward potential will still stand a better chance of making money in that scenario. Now, on the other hand, if the stock collapses, who loses money here? Both very likely do.
An enemy has been slain.
All right, so let's go ahead and place our trade. How do we place this long call vertical spread? Let me show you a quick way to do this. There's a couple of different ways we might place our order. Go to the option chain, let's select the expiration that we've been eyeballing. One way to place our vertical spread is actually just hold down the control key on our keyboard and start clicking. Here's what I mean by that. If I hold down the control key, and you'll be able to see that there are some hotkey prompts, numbers that pop up here, up at the top of the screen. That's just your sign that I'm holding down my control key. You can also see a sort of a circle around my cursor. Anyway, but if we're holding down our control key, what we can do is go to the strike price that we intend to buy and click on the ask. That will create our buy order. We just hide the strike column and don't do that anymore. And then if we go back up to our options chain, I'm just going to tuck this order away for just a moment. Click this little down arrow. It just moves. Our order's still there. It just hides it for a moment. But if I hold down my control key and I then click on the bid price for the contract I intend to sell, it adds that to the buy order. And there's our vertical spread. 77, 79. Looks like it might be about $1.53 debit. I think we were calculating $1.55, so maybe we could move up our limit order to that. We're willing to spend a little bit more because the stock seems to move a little bit higher as we were talking. Maybe we move that debit that we're willing to spend up to $1.60. That's one way to place that order. But one other way some people don't know about is right up here where it says spread single. This, when we have single selected here, it shows us all the individual strikes so we can just trade single leg. If I click on that, we can choose deep and wide. How many of you have used this deep and wide feature before? I'm going to go to deep and wide, 1 month, 2 strike, vertical. This is what this means. We're telling the system, hey, both of these contracts are they have the same expiration. It's just 1 month that we're dealing with, 18th of September. September contract. But these strikes are 2 strikes apart, and I want to trade a vertical that's 2 strikes apart in the same month. So if I choose vertical here, almost it pairs up these strikes. 1 strike increment with the next one that's 2 strike increments away. So the 77 with the 79, the 78 with the 80, and so on. And then if I want to buy a vertical, I can just go to the ask price and click on that ask price, and it creates that same buy order. Bogus and Chili, you've used this before? Yeah. That's a nifty little tool, but so is just holding down the control key. It doesn't matter which way. It doesn't not like we're saving money one way or the other. It's just a click here or there that might be saved. Anyway, but how about, let's say that we're willing to spend that $1.55. That's a little bit off the mid price. natural. Might be improving our odds of a fill here a little bit, but anytime there's a limit order, there's a risk the order might not fill. The trader needs to then calculate how many contracts they're willing to get into. There's an initial cost. This trader's cost is $155 plus commission for each contract there. But also we just have to remember other associated obligations. If we have a call, if we have a long call where we have the right to buy shares for 77, and someone else can buy those shares from us for 79, and we just put this trade in and we close our eyes and let it go to expiration, what if the stock lands between 77 and 79? What if the stock is 78 on the 18th of September, close of business? Well, we might choose to buy the shares because we can buy it for 77. The other party walks because they don't want to pay $79 for a $78 stock, and we wind up owning 100 shares, or 200, or 400, or 1,000, based on how many contracts we get into. We have to be aware of that potential outcome if we allow these contracts to get to expiration. All right, but let's click confirm and send. I'm just going to do the one contract, which is buy one vertical, 18th September 77, 79 call vertical. Willing to spend up to $1.55 per share. 100 shares, that would be $155, plus the 2 commissions to buy and to sell the contracts. That would bring the total cost to $156.30.
Your turret has been destroyed.
Send that order off and see if we do get filled. Yep, filled at 155. All right, so from here, we just need the stock to be above 79, which is where it is, even as we continue to talk here. So guys, we've accomplished what I set out to do. I wanted to talk through a 3-step process, 3 big questions that a trader might ask themselves as they're attempting to whittle down that massive field of potential strategy candidates. Bull, bear, or neutral, buy or sell, and finally reward versus probability. So I hope this has been helpful for you. This is what we do with our Tuesdays. We talk through processes and strategies for getting started with options. Hope you'll join me again next Tuesday. So I'm going to let you go, but before I do, just remember you have a lot of resources available to you to make a lot of education. I hope you're taking full advantage of those. Starting with, make sure that you're subscribed to our Trader Talk channel on YouTube if you haven't done that yet. So our full channel name is Trader Talks Schwab Coaching Webcasts. You can subscribe by clicking the subscribe button below the video right now. It doesn't cost anything to do that. It literally only takes a second. Click, done, you're subscribed. But this is where you can join our live streams, like the one I'm hosting at this moment. You can find playlists of previous webcasts. If I go to playlist and scroll down a bit, let's scroll all the way down. There's getting started with options. If I click on view full playlist, I can see last week's discussion. This one step may reduce the trade risk by 90+%. Now, finally, you can also do keyword searches on our channel homepage and look for topics of specific interest like we did earlier with our Fibonacci's. All right, everybody. That's going to do it. Make sure that you're following your favorite Schwab presenters on social media. You can follow Kevin and me on X and on LinkedIn on X. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. There's my handle right here. It's the profile of the guy you're looking for. But if you reply to my posts on X, I just try to reply right back to you. For example, I asked my followers, hey, 2 words, tell me why the channels on this meta platform look so weird. What's going on? These don't look like this. Because they aren't. So as you reply to these posts, I just try to reply right back to you. It allows for communication in between these live streams. Or you can also follow me on LinkedIn, and I reply to those posts as well. So, like just this morning, I posted a video to X and on LinkedIn. Is Q4 really the strongest quarter of the year? Let's run a 20-year test with Thinkorswim's seasonality chart. And again, as a spoiler alert, Yes, the last 3 months of the year have been the strongest quarter of the year, at least on average over the last. Doesn't mean that's the way 2026 is going to go. But if you reply to my posts here, I just try to reply right back to you as well. Everybody, thanks for giving me your time. I didn't see a survey, but if you ever do see a survey, please fill that out. Thanks to everybody that's clicked the thumbs up or the like button on YouTube. That's always appreciated. It's a pat on the back to your presenter. It also gives me a nice boost in my YouTube algorithm. It helps more people find my videos when you click the like button. So it's like how many? Refresh my browser there. 71 people click the like button. That's awesome. Thank you for doing that. Guys, I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye.
Enemy rampage.
Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today, we're going to be learning a new tool for some people. This is a tool that's sometimes used to automate the rolling of the next covered call on an existing position. That's known as the Strategy Roller Tool. Go ahead, chat in, let me know if you've used it before, but we're going to be using our example paper money portfolio to go through that process and plan a trade for next time. But we'll also be placing a brand new covered call trade today. On to cover. Before we get to any of that, though, first of all, say hello to everybody who's already chatting in. Great to see all familiar names. Hello to anybody that's new. Hello there, Eva, Miraline, Scott, Joseph, Sam, Robert, Kevin, Tony, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, I welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to join us in the live stream audience, this is a Monday webcast series. We kick things off promptly at 2 Eastern Time. Now, I also want to let my live stream audience members know that my very good friend Barb Armstrong is hanging out in the chats with us on YouTube today. She's going to be keeping an eye on any questions that come in, and if I can't get to those, she's there to sort of pick up the slack for me. So thanks for having my back there, Barb. Barb and I would also like to give an invitation to everybody listening, whether live or on archive, to follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find Barb on X at Barb Armstrong CS is her handle there. Or you can find me there on X at Cameron May CS. Or you can jump over to linkedin.com/in. And then again, /Cameron May CS will take you right to my profile there. Give me a follow. But if you reply with comments on my social media posts, I just try to reply right back to you. It is the place to connect with us in between the live streams. But let's get into this discussion of automated rolling of covered call positions. I think it's going to be interesting. And that's going to be done again through the tool known as the Strategy Roller tool. But before we can get to that, of course, there's some important information to cover. Risk is real, so please bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with that said, let's set the agenda for today's discussion. First thing that I do want to do is go through our existing positions in our paper money portfolio. It'll only take us a few minutes to do that, but one of those presented this opportunity for this discussion of this tool today. So we're going to be rolling a covered call today, but using an automation tool known as the Strategy Roller. So after we go through our existing positions, we're going to review one of those positions. We're going to sell a covered call on it and then prepare for the selling of the next one, but we're not going to wait around until next month. We're going to plan next month's trade today and place that order to be done automatically today. All right? So let's get right to the Thinkorswim desktop. Let's see, Merle says whenever I get a prompt, okay, he's talking about we're having a sidebar conversation, which is fabulous, but let's get into the Thinkorswim desktop. This is the paper money platform version of the software. And you can see that we have 4 positions right now. We have 2 covered calls, We have two positions where the calls have expired, leaving us just with over 100 share stock positions. So let's start here with Alphabet. We'll work our way back to Broadcom and CAH. But with Alphabet, we own 100 shares, and we've sold most recently the 18th of September 370 call. And boy, we sold that for 340. It's trading right around 340. So that call is right about break even. Even the stock position's right around break even. So that sounds like overall we're kind of treading water. Not true. Let's go see the history of our Alphabet position. So here's Alphabet. We purchased the shares back here at 349.11. See right now, the stock's almost in exactly the same spot, off by a few pennies, actually down just slightly. But overall, the stock is about break even. And yes, our existing position is essentially at a break-even level. However, previously, we've already sold 3 call contracts against that stock position. We started things off by selling a June 18th 410 call. That expired for a $13.40 per share profit. Now, we leave commissions out of this just to keep it as straightforward as possible, so we chip away a little bit of that for the commission. But $1,340 in realized profit there. Then we sold a July contract, realized another $315 in profit. Sold the August 1st call contract that expired for another $730. So among all of that, about $2,400 of profit have been made that we could add to the apparent break-even scenario that we're in. Actually, our break-even on this trade has been reduced down here to 321.64 thanks to those previous premiums plus some dividends that have already been collected. Let's see, actually we collected 1 dividend. So overall, trade's doing fine. Let's let this call continue to work. It essentially has not changed in value since we sold it last week. Likely swinging up a little bit today as price is recovering. We did have a plan in place that if price falls down below 332, we might consider exiting, but we're still holding above that, so we're going to hold on to that. So let's move on to our next stock, which is our XOM trade from last week. For this, we purchased the shares at this one was shares that were purchased some time ago, 147.64, but we just sold a call. The 18th of September 170 call, collected 255. That's worth 233. Call's doing okay. A little bit. Unrealized gains right now. To be added to the stock doing okay, doing pretty well. So let's have a look at the chart. So with XOM, shares were purchased here. Didn't really do anything with this. The stock was sort of chopped around. And then just last week, we sold that September 18th 170 call for $255. It looks like it's trading for about $233. So if we were so inclined, we might be able to exit at a slight gain on that call. I'm going to leave that one alone, though. Looks like we came up and got fairly close to going in the money, but we're kind of sagging back from that. Break even is down here if we include the premium plus dividends. Yep, 2 dividends collected on this stock, theoretically. For this one, we're going to let this one continue to work. So our 2 covered call positions, we're going to let those continue. Let's have a look at what's going on with Broadcom. We just have 100 shares because our most recent call just expired. That expires for a realized gain. Now, these are all paper trades, but in this case, we sold the 21st of August 410 call. That expired for $11.95 profit. That trade was initiated on July 20th and it just expired last Friday. Today's Monday. You can see price fell down below our strike. We were in the money for a while. In paper money, there's no threat of early assignment. Contracts can certainly be assigned early, even if they're out of the money in real life. But this fell fairly substantially below that strike, just expired worthless. So we may have a decision to make here. First of all, there's an earnings announcement coming up. Do we want to sell a call over that earnings announcement? Let's see, that's on the 2nd. Let's say that we're a trader who prefers not to have a call in place over an earnings announcement. Next question might be, do we hang on to this stock that's misbehaved so badly over the last couple of weeks? We're actually not down very much on the stock, but we were up pretty well, and then surrendered that. How about with this one? Let's make a plan. Looks like there's an old resistance that's been a new support kind of in that 355 range. Do you see that? Let's put in a price level right at 355. I'm going to do this. Let's edit the properties of the line that I've just drawn. Let's make that right at 355, and let's extend it to the right. So we can see that level. You can see how that was the price ceiling for all of these months, and it's been a price floor ever since. And for some traders, pulling the plug right when it seems like we might be at a price floor might be exactly the opposite of productive. Now, obviously, this is not a guarantee that the stock is going to go up from here. But let's say we're going to hold those shares, but we're going to, let's switch up our drawing tool here. Let's say this, consider exiting if support breaks. There we go. Little note there. Let me right click on that and edit its properties. Move its alignment to the right so that you can see the words that we just typed out. And we're going to let that one continue to work, but this earnings announcement, it's not here until September 2nd. I wonder if we could maybe sell a call before September 2nd. Let's go to the trade tab, look at our Broadcom, and this does have weeklies. Here's one. There's one that expires on the 2nd. When was that earnings? Was that before market open? After market close. Interesting. That could still, I don't know if we want to push it that close. What if we were to go to the 28th of August? How far out of the money might we be able to sell some of those weeklies, these expiring before? And let's say we're looking to get around 1%. That might be the 370 strike. That would be, boy, that's pretty close. That's right about here. Let me draw in an expiration just to show you. There's the 28th of August. So we're considering maybe selling a contract here that only has to get that far. But if we sell a strike at 370 is only right here. Let me draw in a line. I'm going to intersect a little bit with that so you can see it a little bit more clearly. If we go above 370, that elevates the risk of assignment. We could still be assigned if we're below 370 theoretically in real life. But what do we do? Should we do it? Is it worth that 1% to surrender some of that upside potential beyond 370 for a while? Or should we just leave it alone, wait for that earnings announcement? I think what we'll do today, let's go ahead and sell that 370. And it's about a 32 delta. I'm going to click on the bid price, create that order to sell that one contract, 370 call for the 28th of August. These are the weekly contracts we need to note. Natural's 345, mid is 350. Let's set that as our minimum. We'll say that we're willing to accept at least 345. And we're going to confirm and send. Selling that one Broadcom 28th of August 370 call, trying to get 345. If we can't get it, it just won't fill. It tells us here that the maximum loss on this trade would be infinite. That would be true if this were a naked call. This is a covered position. We own the stock. That would give us an additional credit of $345 minus the 65-cent commission. $344.35 is the least we would receive if this order fills. But let's send this order off, and we'll see if that can get filled. And we did. Okay, we sold that for $345.
Order
right.
filled.
Now, that leaves us with our CAH position. Mark says, I'm going to stick my neck out, say that you're not going to be assigned at 370. Now, Mark, if this continues to fall, we won't be. If it goes up above 370, that increases. Well, I can't say won't. Won't's an absolute term. We still could get assigned. It's just unlikely if the shares aren't worth 370 that somebody decides just out of the kindness of their hearts to sell the shares to us for 370 anyway, but they could. If the stock goes above 370, we've just essentially agreed to sell those shares for $10 less than we paid for them. Remember, we paid 380 and change. We're agreeing to sell it for 370. So if it's assigned, We lose $10 on the shares. We're down more than that already. We're down 20 bucks on the shares. Anyway, but we've already made a profit of over $12. That would actually be a little bit above break even if that were to happen, plus the $3.45 that was just collected. Anyway, so that leaves us with our CAH position. George says no downside protection, less the premium. Yeah, George, the premium can help a little bit if the stock continues to fall, right? But $3.45 is small. It's little consolation if the stock is falling hard. Let's say we lose another 20 bucks on the shares while we're waiting to see if we can collect and keep the $3.45. Yeah, the $3.45 again is a small consolation prize for a collapsing stock. So we'll see. We'll keep an eye on that in future webcasts. But let's talk about Cardinal Health. Cardinal Health was purchased more than a year ago for $155.40. We've been selling calls. We started relatively recently selling calls on this position, but the stock is treating us quite well. So the stock is making pretty good money. Our most recent call has expired, leaving us with just the shares, so let's look at the history of Cardinal Health. So here was the share purchase. It was actually off the left side of our screen more than 365 days ago, but purchased for $155.40. We really just let the stock do its thing until we started selling contracts in April. Had a realized gain of $1.16 here on the April contracts. Had a realized gain of $4.65 on the July contracts. Had a realized gain of $171 on the August 7th contracts, and then August 21st, another $6.90. That contract expired out of the money. So here we find ourselves just past that expiration, leaving us with just the shares. The earnings announcement is in the rearview mirror. Let's say that our trader here is still bullish about the outlook for the stock, so we're going to retain the ownership of the shares, but let's continue to sell calls. And most recently, those two August contracts were both sold at the 240 strike. I wonder what we could get if we were to look out here to September and sell another 240 strike. Let's go to the trade tab. Let's look at 240. Well, let's move this to September. And move out to 40. Whoops. Yeah, there's that 240 strike, and that's trading between $2 and $2.65. Looks like we might be able to get maybe another $2.30. That would be right on about 1%. I mentioned 1% a couple of times. It's not a hard and fast rule of thumb for every trader that they need to get at least 1% from the value of their contract versus the current price of the stock. That's just, for some traders, they might use that as kind of a benchmark for when those contracts are starting to really dwindle in size.
Whispers on the wind.
Another thing to keep an eye on is that the further we get away from the current price of the stock, the spread between the bid price and the ask price can really start to widen. Those contracts can become quite illiquid, harder to trade. That'll really sort of kick in. That's not unusual to see that happen, even on some more liquid companies as we move out into those low deltas, into the teens, the low single digits. Yeah, Barbara says the spread's pretty wide on these contracts. It is. What is that an indication of?
I hope you brought friends.
I mentioned liquidity. Yeah. Typically, there are narrower spreads between the bid price and the ask price when there's lots of trading on a contract or at a specific price or a strike. Those spreads will widen if there's less trading volume, if there's lower liquidity on given stock contracts. And this one, for some traders, they might look at this and say, you know what, I'm not really thrilled with how wide that spread is. So if they don't like that, they may just choose, all right, I'm not going to sell a call. But we already own the shares. They might decide what to do with the shares at that point. And keep it for capital appreciation. That's fine. Also go down in price. But this webcast series is about selling covered calls and, of course, short puts. Just today, we're talking about covered calls. So I'm going to go ahead with selling a call here, and our spread actually just narrowed a bit. Plus, one strategy when there's a wider spread that may help is to try to get filled closer to the midpoint between the bid and the ask. So how about we build that into today's discussion?
No one is promised.
So let's look at that 240. And if the bid is at 220 and the ask is at 265, let's say we put in our order, try to fill that somewhere in the middle, maybe around 240. I'm going to go ahead and click on the bid price. Let's try to sell that one contract, the 240 strike, but instead of just settling for the natural, basically the current bid, let's try to get at least $2.40. That's closer to the mid price, halfway between the bid and the ask. Now, obviously, whenever we put in an order, there's a risk the order might not fill. I'm going to click confirm and send. Let's sell this one CAH 18th of September 240 call, trying to get at least $2.40 for it. That would provide a minimum $239.35 if the contract fills, if the order fills, including that commission of 65 cents. Let's send that off. Let's see if we can get that filled. And we actually, I really need that to fill to proceed with today's discussion. But you can see it here in our working orders. We're asking 240. The contract, that mid price is still hanging out at 242. It's kind of up in the air whether this is going to fill or not. So now that I've gone through that process, I might go back and back away from this a little bit to see if we can increase the odds of getting that order filled, because I want to use this. Let's cancel and replace this order. Might still fill while we're talking about it. This order is still effective until I confirm and send the new modification. It's still working in the background. But let's maybe say that we're willing to settle for a little bit less. Dial up the odds. Even for this one, you know what I'm going to do? I'm going to put in 220 as the least that I would accept for this credit. Let's click confirm and send. I will follow. Now we've dialed it down to $219.35 after that commission that we'd be willing to accept. Selling that 18th September 240 call. And let's send that order off and see if that gets us filled. You can tell now there's some liquidity and some liquidity issues, and our paper money is doing a good job of reflecting that little bit of a hurdle that we're attempting to overcome. But while that's processing, I want to talk about this strategy roller tool. Now, I asked at the outset, how many of you have used this strategy roller? I'm looking through the chats here. I just had a couple. No, sir, haven't used it.
Killing spree.
Scott says, haven't used that tool.
That's a pretty word.
JRTR says, I know of it. I've not used it. Okay. Ooh, look at that. We finally sold that thing for $2.20. All right. Now, the reason... George says, as a note, if you're very bullish, you wouldn't make this trade, right? Now, I can't speak in absolute like you would or you wouldn't, right? But for some traders, you're exactly right. If the trader is very bullish, they think the stock is going to go up, they might just hold on to their shares and see if the stock does that. For others, even if they're convinced they think the stock is going to go up, they may realize what I think and what the market actually does can frequently be two different things. So maybe in that gray area of uncertainty, let's go ahead and sell a call anyway and at least get some income that comes with of course, the associated obligations of selling a call. Okay, Ricebird says you've rolled but not using the strategy tool. Okay, so here's why I was so keenly interested in getting that order filled. This strategy roller tool only works for existing covered call positions. That's its purpose. So if we just own stock, that's not a covered call. However, if we have a covered call position and we want to roll that call under prescribed conditions, that's exactly what the strategy roller is. It's kind of like if you had a buddy. Let's say you have a friend, and you want to go on vacation, but you want to leave your friend with instructions. Hey, whatever the name is, let's call him Sam. Hey, Sam, while I'm out of town, I want to give you some specific instructions to roll this covered call for me. I want it done on a certain day. I want it done at a certain time. I want it to fill at a certain price and for specific strike I'd like all of that to happen just while I'm out. You take care of it. Sam will probably have lots of questions for you to make sure that he did it correctly. That's what the strategy roller does. So let's go to the strategy roller tool. And you'll notice this strategy roller already knows about our covered call positions. So these are eligible covered call
Your
rolling
team has
positions.
destroyed a turret.
All of these now have covered calls. CAH and Broadcom didn't at the start of this webcast. Now they do because we sold some new calls. So I'm going to use CAH as our example here. So to activate the tool, so all we've done is gone to strategy roller. We click on the symbol to expose these are the workings of the call. We have the 100 shares, and we have the call that we just sold for $2.20. And to activate the tool, we click on the call. It's actually just a normal left click. And that brings up this tool right down here. Now, as I do, by the way, we do have a Sam in the audience, don't we? It's not that Sam. Different Sam. Hypothetical Sam. Anyway, I do, before I go in and fill in this tool, I do want to point out we could have launched this from another area. So for example, if I scroll down here and just click cancel, right? If we were instead just on our activity and positions and I were looking at the CAH trade here, I could right-click on the call from here and choose Create Rolling Strategy from the menu. Not Create Rolling Order, that's different. But Create Rolling Strategy will take us to that same screen. It'll have CAH queued up to create our strategy roller, and it has the tool activated. So first of all, I'll point out on the right side here, it can just give us, for you technicians, it just gives us a quick visual reference for where the price is. It also applies the probability cone. I don't know if you know what the probability cone, but it's just the probability of the contract expiring within a given range, 68% probability at different dates. That's what that is. Don't necessarily need to worry about this. Instead, let's say, over here to the left, we have in our mind the instructions that we want to give to Sam or to Thinkorswim to roll our call later. So you'll notice, first of all, it says, it tells us which call we're dealing with. So we have CAH, and we have that call that we just sold for the 18th of September, the 240 strike. Next up, we want to tell it the conditions for rolling that call. Obviously, we just put that call on right now. We probably don't want to get out of it right now. But for our next roll, we do want to keep the quantity consistent. If we have 100 shares, maybe we just make sure we put it a -1. If we had 200 shares, it would be -2, and so on. So that's pretty straightforward. Next up, we need to tell the system here which strike price to choose. So the first thing that we can do, we have a couple of different choices. We can tell the system to look a certain number of strikes out of the money. So if I were to go to our trade tab, and if we were to look at the current arrangement of strikes, well, the one that we chose today, the 240 strike, is let's see, it stops right at 230. That's interesting. Look how close we're right at exactly 230 within a few pennies. So we're 1, 2, 3, 4 strikes out of the money for September.
Shut down.
But the thing is that a little bit of caution here in using this feature in the strategy roller. The same number of strikes doesn't take us the same dollar amount out of the money every time. So for example, if I were to look at, let's say, October,
Your turret has been destroyed.
and we go 4 strikes out of the money, 1, 2, 3, 4, we're not at 240 anymore, we're at 270. Because September has $2.50 strikes. October has $10 strike increments. So that's different. So, yes, using this tool, we can choose the number of strikes either out of the money. Notice if I click plus, it takes us a given number of strikes out of the money for the new call, the future call that we'd be selling. We could go in the money. Typically, a trader would go in the money if they're really comfortable with the idea that there's a high risk of assignment. But they might also do this when they're trying to get larger premiums, when they think the stock is really going to go down in price. That's a possibility. Now, another thing that we might do is choose the delta. This is probably a more direct way to standardize an adjusted distance out of the money. So we can choose, for example, with the contract that we sold today. What was our delta on that? I think it was 27. 240 strike. Right now it has a delta of 28. Let's just say that our trader has a preference for selling contracts that maybe have a delta around 30. That's always going to position that trade out of the money, and really it's going to be fairly consistent from one expiration to the next regarding how far out of the money relative to the probability of assignment. So how about for this example, we're going to choose the delta, and we can use a little slide bar to set our delta. Let's slide that on down to, let's say, 30 delta. Now, just so you know, before we do that, if we were to go up to higher deltas, what does that do? That takes us in the money. Higher probability of assignment, that would be for also higher premiums. With lower deltas, we're accepting smaller premiums, the lower probability of assignment. So I'm going to choose the 30 delta. Now, at the moment, the system rolls or attempts to roll this contract. There may not be a 30 delta available at that second. Notice there's not even one available right now. It's 28, and I think it skipped to like 33. Or 20, yeah, 28 up to 32, down to 21. At the moment this attempts the roll, what it'll do is it'll just get the one that's closest to our selected delta.
An enemy has been slain.
Right? So let's choose 30 in this case. So we're looking to roll one contract to a 30 delta, and now we can tell it how far out to roll. We can go out a week, we can go out a month, or 2 months, or 3 months, or 4 months. Let's say that our preference here is going for 1 month, saying there's a little reminder that pops up. Number of trading days from expiration must be between 1 and 5. That's fine. Anyway, but we're looking to roll this out 1 month to the 30 delta, one contract. Now there are some additional options here. If we want to get more particular about the instructions that we're leaving with Thinkorswim. These ones require a little bit of explanation. First of all, when do we want this roll to be attempted? Let's say that we want it to be in that final week before expiration. Let's go to 4 days. 4 trading days before expiration, we want to try to roll the contract out to a 30 delta, 1 month further out, rolling that one contract. The order price, see where it says 50%? Notice the range here. It's a little bit faint, but we have the mid price and the natural. So are we trying to get filled right at the mid? That would be down here. Are we okay paying halfway between the mid and the natural? Or are we willing to go all the way up to the natural? Basically willing to just accept the bid price in this case, a lower price. Now, just if, let me leave it here at 100% saying that we're willing to sell at the natural. What the system would do in this case is it would begin to try the roll at the mid price. But over the course of a period of time, and we select that time right here, let's say that we activate this at 8:40, this would be my local time here in the mountains of Utah, 8:45 a.m., 4 days before expiration. The system will come in and start to attempt a roll. And it's going to try to roll out 1 month to the mid price. If that doesn't work, for the next 15 minutes, it's going to work toward, all right, if we can't get the mid, we'll go a little bit closer to the national, a little bit closer to the national, a little bit closer to the national. up to the natural. Now, if we don't want to go that high, maybe we go 3/4 away between them and the natural. The trader just picks their maximum here. What is the least they'd be willing to accept in order to accomplish this roll? How about for this? Let's just go ahead and say we'd go all the way to the natural if we